What's up guys, welcome back to the daily stock picks, and in this video we'll be going over the top 2 high growth stocks that you should consider buying right now in September 2020. Just to give you guys a heads up, this is based on an article that I've read from Investors Place. So what I'll be doing for you guys is I'll be reading over this article along with the relevant companies, commenting, and we'll be conducting my own quantitative analyses to see whether those 2 high growth stocks either belong in our dividend portfolio or our value portfolio by using this checklist. More on that later. If you guys feel like being amazing, make sure that you smash the like button for the YouTube algorithm if this video has saved you a lot of time instead of reading this article, and I've expressed my comments and given you a heads up on your research thesis. So now, without further ado, let's get this video started. So the 10 best long-term growth stocks to buy for the next 10 years. The best time to buy long-term growth stocks is when it looks like the sky is falling, by Luke Lango. So editor's note, 10 of the best long-term stocks to buy in a bear market was originally published in June 2020. It is regularly updated to include the most relevant information. There is a lot of volatility in the stock market right now, thanks to the novel CVPD, social unrest, and rising geopolitical tensions. This S&P 500 index will shoot up 2% on one day and fall back 3% the next day. Amid these wild swings in the market, my advice is refreshingly simple. Ignore the noise and find long-term growth stocks to buy and hold for the next decade. The pandemic, the protests, tensions in Asia, all of these things are fleeting. They will pass like every economic, social, and political panic before. But the secular growth narrative supporting long-term growth stocks, like the pivot from on-premise to cloud software, the proliferation of 5G technology, the digitalization of services, the migration towards e-commerce, and the explosion of data-driven processes, the emergence of streaming TV, those things will last long after today's macro issues pass. Indeed, they will last for the next decade, and as they do, the long-term growth stocks built on top of those narratives will brush off today's volatility and charge higher. To that end, the 10 best growth stocks to buy now and hold for the next 10 years include, these are the 10 stocks that they mentioned in this article, but these are the 2 stocks that I found out had the most potential in terms and were fundamentally really strong from the looks of the the numbers and stuff. So now let's have a look at the first company in this list, which is Square, ticker symbol SQ. Year-to-date performance is 141% increase. Payment processor Square is an innovative company, optimally capitalizing on one of the biggest trends in the consumer world. Across the globe, consumers are increasingly ditching cash and opting for alternative payment methods. Square is capitalizing on this cashless commerce trend in 2 big ways. First, the company has built cashless payment processes for merchants and retailers. They've also built a robust seller ecosystem around those payments processor. That ecosystem includes offering like payroll management, small business capital management, and commerce analytics. Second, the company has built a cashless peer-to-peer payment app called the Cash App and created a robust buyer ecosystem around that application, offering things like the fractional stock trading and debit card with unique promotions. In other words, through innovation, the company has aligned itself perfectly with cashless revolution. This revolution is truly just getting started. By 2025, it's quite likely that cash, which is still fairly prevalent today, will be a rarity. Now, in order for a company, in this case for Square, to meet a part of my dividend portfolio, it needs to be 4 rules, and these 4 rules or principles are based on these books that are shown on the screen that I highly recommend checking out. So the first rule that I like to follow meticulously is that the company needs to provide positive free cash flows. So we want to be making sure that we are investing in companies that are indeed profitable, rather so that you can go to sleep well at night. And rule number 2 is that the dividend that it's paying out should not be more than 75% of the current free cash flows, meaning that the company has at least 25% of its free cash flows that can be retained back into the business if anything if the company does come into any financial problems, it has sufficient cash to cover that. And rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. But a rule of thumb, if you want to be on the most conservative side, you can look for 10 years as well. And rule number 4 is our buy criteria. We only, and I mean only, want to be buying into this company when the current dividend yield is greater than or equal to the 5-year dividend yield average. Now, looking at Y charts, we can see that, typing in the ticker symbol square, we can see that it does not pay out any dividends if you divert your attention to this part of the screen. So as a result, this cannot be part of a dividend portfolio. But if you were to type in square in this particular spreadsheet, you can see that it is current price to earnings ratio is 308, which it was definitely on the expensive side when compared to the S&P 500 index. Now let's have a look and see if it meets a part of our value or our growth portfolio. And these are based upon these 3 books. And my personal favorite is this one, which is called The Little Book That Still Beats the Market by Investor's Place. By Joel Greenblatt. And the rules are as follows. The return on invested capital must be positive, meaning that this basically shows the profitability of the company. The higher this ratio, the better the company is fundamentally, as it has some sort of competitive advantage working in its favor. Number 2, it needs to have consistent cash flows so that we can project the cash flows to a certain extent into the coming 10 years. And rule number 3 is that it needs to have a strong balance sheet. So we want to be making sure that the long-term debt that the company has, it can clear it off within the coming 6 years or so. If the management decides to do so, this can be either from the current assets or the free cash flows that the company is able to generate. And now rule number 4 and rule number 5 are our buying criteria. So we want to be buying the stock when it is at least at 80% of the fair price, or that what it actually means is that it is at least at an 20% discount from its fair price, which we'll be calculating within a few minutes. Now, the rule number 5 is generally implemented if rule number 4 isn't met. Rule number 5 is purely based upon the price to earnings ratio. If the price to earnings ratio is less than 50% of the highest price to earnings ratio over the past 5 years and cheaper than the S&P 500 index, we can consider buying the stock in terms of a value growth perspective. Now, looking at this, we know that rule number 5 is out the door because it's 308 when compared to 28.79, which is definitely not at a discount when compared to the broader market. Now, looking at Square, we can see that the return on invested capital was negative for a couple of years, which we wouldn't even have considered it. And this, back in 2019, this is the time it has been positive of 16.07%. Now, looking at this, the return on invested capital definitely is greater than 10%. Now, and the current cash flows, these are just bananas, guys. It has increased its cash flows from minus $55 million, it was basically bleeding cash, to $403 million. That growth rate would have been phenomenal, but we can't calculate the exact amount because it's from a negative figure. Yeah, but consistent net cash flows, yes, it started to turn out profits from 2017, and it has been growing substantially from that time frame, nearly doubling its money every single year from that time. Now, the current assets, now let's have a look at the balance sheet. It has around $2.2 billion. If the company decides to do so, it can liquidate its current assets within the coming 12 months to pure cash and pay off this long-term debt. So definitely a good balance sheet in terms of a long-term debt perspective. Now let's calculate the intrinsic value of the company. We can see that the earnings per share is 62 cents per share. And looking at Square, we can see that Square has been trading at a price to earnings multiple of 48.83 and 268.81. And the analysts at Wall Street are basically estimating that the company could grow somewhere around 35.59%. That would seem pretty awesome because over the past 3 years, it has been doubling every single time, around 100% if you know what I mean, looking at the previous trends. Now, looking at this, we can see that the intrinsic value of the company would be somewhere around $683.59, and the right time to buy the stock would be somewhere around $155.46. And if you were to consider a 50% margin of safety, the right time would be $97. But either way, if you were to look at the company's fundamentals, it is pretty strong and its growth rate is pretty phenomenal. And I think that this is pretty conservative number as well. And I don't see any problems with that holding up into the coming 10 years. So it is at more than a 20% discount. So as a result, I would consider Square as a part of my value growth portfolio. Value portfolio as in rule number 4. As it is at least at a 20% discount from its fair price. Now, looking at the last company in this list is The Trade Desk. Year-to-date performance is 71.21%. Programmatic advertising is the future of advertising, and as a result, The Trade Desk is a long-term winner. What The Trade Desk does is pretty simple. The company provides programmatic advertising solutions for ad buyers. Breaking that down, The Trade Desk leverages data and algorithms to allocate demand ad dollars across a variety of digital ad channels. This helps optimize the reach and effectiveness of those ad dollars. This is simply a better way to advertise. It's faster because it's all automated. It's smarter because it's all data driven, and it produces better outcomes because it increases the effectiveness of each ad. Yet, only a small fraction of the world's 500 billion plus ad dollars are spent programmatically, giving The Trade Desk a ton of runway to grow the market share and sustain big growth for a lot longer. I see this company as a 20% plus revenue grower over the next few years with a strong and stable profit margins. My model suggests that $12 in earnings per share in the possible by 2025. Now let's have a look at Trade Desk, ticker symbol TD. You can definitely see, it's TTD, my bad. It's 169, which is definitely on the expensive side when compared to the S&P 500 index. And I don't believe that Trade Desk also pays out any dividend because they're basically targeted for growth. Yes, as expected, so can be a part of our dividend portfolio at the way that this company is growing at the moment. Maybe in the future, if they decide to pay a dividends, we can revisit that. Now, looking at the current return on invested capital, the lowest was around 14.98, showing that the company does have some sort of competitive advantage working in its favor. Yep. And the revenue, it's almost a linear line from the past 10 years or from since 2014, and it has been increasing its free cash flows to a certain extent, but it is a little bit vary, but definitely the cash flows have been growing consistently. Now, looking at its balance sheet, the long-term debt is $142 million, which it can easily pay off within the coming 12 months if the management chooses to do so. Now, looking at the intrinsic value, it's trading around $2.48 per share. Now, the price to earnings ratio for The Trade Desk, if you can see, it was around 37.22, 207.66. And analysts are estimating that Trade Desk should be growing somewhere around 25%. Okay, and that would put the intrinsic value of the company at $923, and the right time to buy the stock would be $210.10. So as a result, it wouldn't be a part of our growth portfolio, but yes, it does have a really good future aspect working for it, but its current valuations, we want to be waiting for the company to at least fall. The analysts are also stating that it's a 2.6, somewhere between a buy and a hold, and their current price target is $477.59. If you were to look into it in terms of short-term perspective, which I highly recommend not doing, if you were to look at it in terms of a long-term perspective, I would say that wait for the stock to fall down a little bit, then you can buy it based on the rule number 4. But currently, I would advise you to wait on these two stocks. These two stocks out of the 10 companies that are mentioned in this article are fundamentally strong and have really good balance sheets and stuff, just in case if anything happens to the projected growth, just so that we know that the management are sufficiently equipped with resources to come out of that rut if the company chooses to do so, right? Out of all of these two companies, we can see that Square is definitely a buy at its current valuation right now, and the trade desk, I would recommend waiting before investing into the company. So closing remarks, Luke Lango is a market analyst for Investor Place. He has been professionally analyzing stocks for several years, previously working at various hedge funds and currently running his own investment fund in San Diego. A Caltech graduate, Luke has consistently been recognized as one of the best stock pickers in the world by various other analysts and platforms, and has developed a reputation for leveraging his technology background to identify growth stocks that deliver outstanding returns. Luke is also a founder of Fantastic, a social discovery company backed by an LA-based internet venture firm. As of this writing, he was long Shop, Okta, Chegg, Pins, Beyond Meat, Roku, Square, TTD, and SFIX. So, thank you guys so much if you had stayed around till this part of the video. I really appreciate it, but I do want to let you guys know on the full disclosure that this video is for your education and your entertainment purposes only. Please do your research before investing in any of these two companies that I mentioned in this article, because involving buying in stocks, it does come with the risk of losing your principal. Now, just to give you guys, if you really liked this video, make sure that you subscribe and turn on the bell notification icon so that you can get notified as soon as we post new videos. We post from Monday to Friday. Thank you for watching, guys. See you in the next video. Peace.